Okay, so good day to each and everyone. So for valuation uh, and valuation concepts and methods, so we are now into the last topic. So we have the mergers and acquisitions. So in this topic, we are going to discuss the following. So the types of mergers, merger analysis, continuing value, shareholder wealth, and lastly is the role of the investment bankers. So why do businesses um, enter into merger? Okay, so by the way, there are two merger and acquisition, so they are different. So when you say merger, so um, one firm will buy another firm, and the firm that is bought will cease to exist. While in the acquisition, so the two firms will merge or will combine their assets and equity. So, but they will form another firm or another entity. So, why do businesses engage into merger or acquisitions? So, the primary reason why businesses enter into merger is what we call the synergy. Okay, so synergy means the value of the whole exceeds the sum of the parts. So, for example, firm A and firm B. So so let's have their value is 100 million each. But when they merge together, their value becomes, let's say, 250 million. So the whole value of the combined value of the two firms is higher compared to the sum of the individual value of the firms. So how this synergy uh, can get from? So it could arise from these reasons. So first we have the operating economies. So they can save operation cost or operational expense if they combine their assets or uh, combine their firms together. So in the case of mga food and beverage nga companies, so their operations are complementary to one another. So it could probably arise from it could give operating economies. Another is the financial economies. So they can benefit or they can lesser their finance cost when if they combine together rather than operating individually. Another is differential management efficiency. So they can achieve higher efficiency if they combine their operations. And another is the increased market power. So it will if they combine, so it reduces the competition. So this new firm now will have a new market share or a big or a large market share. Then taxes. So especially if they are buying, or if this firm will buy a firm that is losing, so katong loss ato will be shouldered by the buying firm. So that loss will become a tax benefit or tax shield. So in the combined firm, they will reduce their taxes. Breakup value, so assets would be more valuable if sold to some other company. So what are the some questionable reasons for mergers, or what are the reasons that might be stopped by the government? Okay, so of the regulatory agencies. So first is diversification. Okay, so some firms para mo lesser ilang competition is they will buy their competitors. Okay, so if the government will always allow this type of diversification, it might create in the future a monopoly nga business. Okay, so let's for example, In the case of telco, so for example, if PLDT will buy Globe, so let's say walay other telephone companies, so it could create a monopoly nga type of business. So of course, in the monopoly, so ang gansi ana is ang consumers. So this type of reason would be scrutinized by the government. Another is the purchase of assets at below the replacement cost. So probably reasons why they merge is to buy assets of another company below their fair market price. So of course, those merged companies will become big. So in terms of money, in terms of strength, so mas dagay magpautang ana nga company. So get bigger using debt finance mergers to help fight off mga takeovers. So there is what is the difference between a friendly and a hostile merger? So a friendly merger is supported by the managements of the firm. So if both of the management of each firm agrees to the merger, then we can say it is a friendly merger. But if it is forced, okay, so one management, especially the target firms or the firm that is going to be acquired by another firm, is resisting the merger, okay, so we can say that's a hostile merger. So the acquirer must go directly to the target firm's stockholders and try to get the controlling percentage. So let's say 51% of the shares. So if they get 51% of the shares, so the acquirer becomes the controlling entity. Often, that start out hostile end up as friendly when the offer price is raised. So, of course, before the company will engage into the merger, so the acquiring firm or the firm that is going to buy the other firm will have to analyze the or get the value first of that target firm. So that they will know kung pila ang i-offer nga price is or what would be the maximum price nga pwede nila iset to buy the shares or buy the firm. So so the first thing to do is to get the value of that firm. So we have the historical statements, or let's say it could be kung 2014 karon it could be mga forecast. So these are the following forecasts. So retentions refer to the part of the income nga dili pwede gamiton sa acquiring firm. So it should be reinvested in the firm. So the total cash inflow per year. So for 2015 it's 9.9 million, 2016 is 7.8 million, 2017 is 13.8 million, and then lastly is 17.1 million. So after getting the cash flows per year, so the next step would be computing the present value. Why is interest expense included in the analysis? So debt associated with merger is more complex than the single issue of new debt associated with a normal capital project. So some firms will borrow money to be used to, and then the proceeds will be used to buy the other firm. So acquiring firms often assume the debt of the target firm. So there are firms nga pagpaliton ni niya nga firm, dili lang assets iya ma-carry makuha pati ang liabilities ana nga firm. So all debt at different coupon rates is often part of the deal. So the acquisition is often financed partially by liability. And if the subsidiary is to grow in the future, so new debt will have to be issued over time to support its expansion. So why are the earnings retentions deducted in the analysis? So if you want the subsidiary to grow, so not all income must be assumed by the parent firm. So the subsidiary must reinvest some of the earnings to sustain their growth. So what discount rate should be used to compute the present value of the cash flows? So estimated cash flows are residuals which belong to the acquirers, shareholders. They are riskier than the typical capital budgeting cash flows because fixed interest charges are deducted. This increases the volatility of the residual cash flows. So because the cash flows are risky equity flows, the discount rate that should be used is the cost of equity rather than the weighted average cost of capital. So they're discounting the target's cash flows. So the cash flows reflect the target's business risk, not the acquiring companies. However, the merger will affect the target's leverage and tax rates, hence its financial risk. So continuing value, so if we want to continue the firm, then get the cost of equity for that firm. But first, to get the continuing value, you have to calculate first the cost of equity using the capital asset pricing model. So the market risk for that firm. So the risk-free rate is 9%. The market risk or the market risk premium, so market rate minus the risk-free rate is 4% multiplied by the its beta or the riskiness of that firm. So the cost of equity is now 14.2%. So mo na dayon ni gamiton to compute for the present value. So we already know the cash flows from until 2008 in the 2018. So to get the continuing value, so cash flows for 2018 multiplied by 1 plus the growth rate. So 6% is the growth rate divided by the cost of equity minus the growth rate. So that's the continuing value. So kaning value 221 million. So mo na ni ang minimum price that you will offer to the target firm. Okay? So dili man basta-basta nga mo offer lang kag price without computing the value of that firm. So now that you have the value, you can now make decisions as to the offer price nga imong iset. So it could be the mo gini ang price or it is the maximum price that you will offer to the target firm. Okay, cash flow stream. So 2015 is it's 9.9, 2016 is 7.8, 17 is 13.8. So we already computed this when we discussed the merger analysis. So for continuing value, so i-add siya sa 2018 nga cash flow. So now we can get the value of the target firm. So using the discount rate nga 14.2%, so solve for the net present value or the present value of the firm. So the present value is 163.9 million dollars. Would another acquiring company obtain the same value? So no, because the input state estimates would be different and different synergies would lead to different cash flow forecasts. So kung lahi na pud ang kung itahay lahi nga company ang mo palit, of course the value of the firm would be different because they will have a different synergy or reasons why they will merge with another company. So also a different financing mix or tax rate would change the discount rate. So the target firm has 10 million shares outstanding at a price of 9 pesos, $9 per share. So what should be the offering price? So remember that when we do the merger, so you can either buy the company or buy its shares, okay, or equity. So the acquirer estimates the maximum price they would be willing to pay by dividing the target's value by its number of shares. So for in this case, so if the target firm has 10 million shares, tapos kada share niya, the market price is $9, then the value of that firm, okay, so or the maximum price per share would be 16.39. So we already computed for the target's value gaina, that's 163.9 million, divided by the number of shares, 10 million shares. So the maximum price that you can offer to the firm, target firm, is 16.39 per share. So your the offering range or the price range nga pwede nimo i-offer to the target firm, it is between the market price or the current fair value of the share, which is $9, and atong na-compute nga maximum price by the shares of the firm, then mo ni ang price range para dili malugi ang mo acquire nga firm. So making the offer, so since the offer could range from $9 to 16.39 per share. So at $9, all the merger benefits would go to the acquirer's shareholders. At 16.39, all value would go to the target's shareholders. Okay, so of course, the lower the price nga imong i-offer, mas maka-benefit ang mga nag-acquire nga firm kay cheaper ang iyang price sa pag buy sa shares. However, if you buy it at 16.39, the benefit or the value added would go to the uh, acquired or the target nga firm, okay, among ilang mga shareholders. So acquiring and target firms must decide how much wealth they are willing to forego. So shareholder wealth in a merger. So at $9, so mas maka-benefit ani ang acquirer. At 16.39, it's the target firm nga shareholders. So that's why they have to meet halfway. Okay, so para equal ang ilang i-give up nga benefit or cost. So the bargaining range is between $9 and 16.39. Okay, shareholder wealth. So nothing magic about crossover price from the graph. So the actual price would be determined by bargaining higher if target is in a better bargaining position. So if the target firm has more bargaining power, okay, than the acquiring firm, then the target firm would the price would be set at a higher price. However, if the acquiring firm has more bargaining position or more bargaining power, then the price would be near to $9. So if the target is good fit for many acquirers, other firms will come in, price will be bid up. So if not, then it could be close to $9. Acquirer might want to make a high preemptive bid to ward off other bidders or make a low bid and then plan to increase it. So it all depends upon the strategy. Do target managers have 51% of stock and want to remain in control? So it's up to them if they want to have a controlling power or just uh, enough. Okay, so let's say 20%. So just to become an associate of that firm. What kind of personal deal will target managers get? Okay, so aside from the price given to the company, so of course you have to persuade the management of the target firm to agree with the merger. So aside from the offer price, probably you will pay or reward the management of the target firm. So, do mergers really create value? So, the evidence strongly suggests that acquisitions do create value as a result of the economies of scale, the other synergies, and or better management. Shareholders of target firms reap most of the benefits because of the competitive bids. And then lastly, we have the investment bankers. So in facilitation of the merger or acquisition, so the firms must hire the services of the investment bankers. So what are the functions of these investment bankers in mergers? So first is they are the ones who will arrange the merger. So they will assist the target firm in getting the price or setting the price that should be that can be offered to the acquiring firm. The investment banker can assist in the defensive tactics or tactics that would ward off some bidders, and then establishing a fair value. So the value of those firms, financing mergers. So perhaps sa ilalap ang acquiring firm, diha ra pod magborrow og money para ipalit sa target firm. And lastly is the risk arbitrage. So it's the mitigation of the risk of merger. Okay, so okay, so there are four classifications of mergers. So I think wala siya na-appeal dire, but there are four classifications of merger. The first merger is called the vertical or the horizontal merger. So if you buy a business with the same business model or same business, so like for example, Jollibee buying Mang Inasal, so that's a kind of horizontal merger. Vertical merger is either buying your supplier or your buyer. So for example, if na kay restaurant business or perhaps you have a farm and then you want to buy a restaurant, so that's an example of a vertical merger. Another is a congeneric merger. So it's a merger which the acquiring firm buys a related niya business. So let's say if naa siya sa business industry o sa food business industry, so food rapod niya mga entities or food rapod niya mga business entities iyang paliton. Okay, let's say restaurant or palit siya ka ng firm that sells mga drinks. Okay, that's called congeneric. And lastly is the conglomerate merger. So you are buying a firm that is unrelated to your business. So for example, ang PAL, okay? So ang PAL nagbuy siya og firm nga mo supply sa ila og snacks. So which is a food industry. So they are unrelated. So that's a conglomerate type of merger. Okay, so so just to recap what we have discussed. So we have discussed the merger types, the reasons why firms enter into merger, how to do the merger analysis, compute the continuing value, and computation of the target values, a target firm's value, the shareholder wealth. So how are they going to bargain the price? And lastly is the role of the investment bankers. Okay, so We are done. Now, if you have questions or clarifications, please feel free to email me or to directly message me in my messenger. Okay. So thank you for watching. Thank you for listening to this lecture video. Okay. Have a good day.